In 2026, the average American investor holding a diversified portfolio still underperformed the S&P 500 by nearly 6% annually, not because they picked bad funds, because of what they did after they picked them. And the 5 ETF portfolio trend, sweeping financial content right now, is quietly walking people into the exact same trap. My name is Martin, and today we're auditing the claim that a simple 5 ETF portfolio beats most investors. The claim is true, but almost nobody explains why it's true. And that gap is where people lose money without realizing it. Let's start with the benchmark, because most people get it wrong immediately. When someone says a portfolio beats most investors, they assume that means beating the market. It doesn't. According to Dalbar's 2025 quantitative analysis of investor behavior, the average equity fund investor earned roughly 3.7% below the S&P 500's return over the trailing 20-year period. Here's the part that surprises people. That gap didn't come from picking worse investments. It came from timing, buying after a rally, selling after a drop. The fund itself often performed fine. The investor's behavior around the fund did not. So when someone claims a 5 ETF portfolio beats most investors, they're really making a behavioral claim, not an investment selection claim. The bar isn't the market. The bar is human panic. And that distinction matters because a 5 ETF portfolio can clear that low bar while still being built wrong. Here's where it gets interesting. Most people assume 5 ETFs automatically means 5 different bets. It doesn't. This is the part almost nobody checks. Take a common version of this portfolio: a total US market fund, an S&P 500 fund, a large cap growth fund, a technology sector fund, and an international fund. 5 tickers, 5 names. It looks diversified on a screen, but run the actual holdings overlap, and something different shows up. The total market fund and the S&P 500 fund share roughly 85% of the same underlying companies. Add the growth fund and the tech fund, and the same handful of mega-cap names. The largest technology companies in the country show up as top holdings in 4 out of the 5 funds simultaneously. What looks like 5 separate positions is functionally one concentrated bet on a small group of companies, repeated 5 times under 5 different labels. This is the correlation trap, and it's the single most common mistake in portfolios marketed as simple 5-fund strategies. The investor thinks they've spread their risk 5 ways. Mathematically, they've spread it maybe 1.5 ways. This matters because diversification isn't about how many funds you own. It's about how differently those funds behave when something goes wrong. 2 assets are only doing real diversification work for you if they don't move in the same direction at the same time for the same reason. If 4 of your 5 ETFs all drop together because they all own the same 20 companies, you haven't built a 5-fund portfolio. You've built a single fund wearing a disguise, and you're paying 5 expense ratios to maintain the illusion. There's a quieter cost hiding inside that overlap too. Each of those funds charges its own expense ratio, and when the same underlying shares are represented in 4 different wrappers, an investor is often paying overlapping fees to hold the same stock multiple times. It doesn't show up as a single obvious charge. It shows up as a slow, invisible drag that never gets audited, because nobody thinks to compare holdings across funds they already own. So the real question isn't whether a 5 ETF portfolio can beat most investors. It's whether the 5 ETFs someone actually picked are doing 5 different jobs, or whether they're doing the same job 5 times while charging 5 different prices for it. That's the flaw hiding inside the popular version of this strategy. What a portfolio needs instead, to actually earn the diversification it claims to have, is a structure built around genuinely different risk drivers, not just different fund names. A properly built 5 ETF portfolio spreads across categories that actually respond differently to the same economic event. One fund covering the total U.S. stock market, one covering international developed markets, which historically move with roughly a 0.7 to 0.8 correlation to U.S. stocks, close enough to still connect, but loose enough to cushion certain downturns. One covering emerging markets, which behaves differently again, often decoupling from U.S. markets during specific economic cycles. One covering bonds, which frequently move in the opposite direction of stocks during market stress, and one covering real assets, or REITs, which respond primarily to interest rates and inflation rather than corporate earnings. 5 funds, 5 distinct economic reactions. That's the difference between diversification on paper and diversification in practice. According to Vanguard's 2025 index research, a portfolio built this way, with meaningfully low cross-correlation between holdings, reduced overall portfolio volatility by close to 22% compared to a single all-stock index fund, without meaningfully reducing long-term average returns. But structure alone doesn't finish the job. The second requirement is rebalancing, and this is where most 5 ETF portfolios quietly fail without the investor ever noticing. Say someone builds their 5-fund split evenly at 20% each. 3 years of a strong bull market later, the stock-heavy funds have grown, the bond fund hasn't kept pace, and without a single trade being made, that portfolio has drifted into something that's now 70% stocks and 30% everything else. Nobody decided to take on more risk. The portfolio decided for them, silently, 1 quarter at a time. Research from Morningstar's 2024 Portfolio Behavior Study found that investors who rebalanced annually captured meaningfully more of their portfolio's designed return than those who never rebalanced at all, simply because rebalancing forces an investor to sell portions of what's gone up and buy portions of what's lagged, which is the exact opposite of what panic and greed tell most people to do. Now let's run the actual numbers. 2 investors, both 35 years old, both starting with $50,000, both adding $500 a month for 20 years. The first investor builds the naive version. 5 ETFs, heavy overlap, mostly variations of the same U.S. large-cap exposure, no rebalancing schedule, and lets it ride. During a market downturn in year 8, a 34% drop across his overlapping holdings triggers panic. He sells roughly 40% of his position and moves it to cash, missing the recovery that follows over the next 14 months. Combined with overlapping fees eating an estimated 0.6% annually across his redundant holdings, his 20-year ending balance lands at approximately $412,000. The second investor builds the structurally sound version, genuinely uncorrelated holdings, rebalanced once a year. She experiences the same market downturn. Her portfolio only drops 19%, because her bond and real asset funds cushion the blow. That smaller, less frightening drop means she never panics and never sells. Her annual rebalancing routine even has her buying more stock funds at the bottom of that dip, using proceeds from her steadier bond position. Her 20-year ending balance lands at approximately $541,000. Same starting capital, same monthly contribution, same 20 years. A gap of $129,000, and none of it came from picking better companies. It came entirely from structure and discipline. So, who does the 5 ETF portfolio actually serve? It serves the investor who builds real diversification into it and commits to checking it once a year. It does not serve the investor who buys 5 funds that all secretly hold the same 20 companies and calls that a strategy. Which brings us back to where we started. That average investor underperforming the market by nearly 6% a year wasn't failed by the market. He was failed by a portfolio that looked diversified and wasn't. paired with a moment of panic that a truly diversified portfolio would have prevented in the first place. A 5 ETF portfolio can absolutely beat most investors. But it isn't the 5 funds doing the beating. It's whether those 5 funds are actually different from each other, and whether you're disciplined enough to leave them alone until it's time to rebalance. So before you copy anyone's simple 5 ETF portfolio, ask one question. Are these 5 funds really 5 different bets? Or is it one bet wearing 5 different name tags? If you're not sure, subscribe, because that's exactly the kind of math we run on this channel every week.